All right, is volatility really back for October? 30 minutes until the start of trading. I'm Matt Miller.
And I'm Katie Greifeld. Sonali Basak on assignment. Bloomberg Open Interest starts right now. I go over.
Coming up, Wall Street is set to open stronger as the China bull run loses steam after a week-long holiday. Principles for the economy and investing. Billionaire Ray Dalio Bridgewater speaks to Sonali Basak, our very own, live from the Greenwich Economic Forum. Plus, an exclusive conversation with Jamie Dimon, the JPMorgan CEO, talks global markets, tech investments, and the election. First off, though, let's take a look at what's going on in terms of markets. We had a down day yesterday, closing off almost 1%. Now we see futures higher, even though China is lower after, as I said, a week's holiday. So the S&P 500 futures right now about 0.4%. NASDAQ futures up just about the same, and the 10-year yield holding pretty steady over 4%, Katie.
All right, some stocks to keep an eye on, of course, before the bell. Hindenburg strikes again. Roblox falling after Hindenburg said it's shorting the video game stock. We're going to continue to keep an eye on that one and bring you more, but Roblox shares currently lower by almost 10%. Pre-market. You go down the list, we have some good news, and that is Supermicro shares surging for what would be a second day after the company said it recently deployed over 100,000 GPUs in one quarter. Meanwhile, Honeywell will spin off its advanced materials division. The move is supposed to create greater financial flexibility for deal making, and spin-offs very hot right now, Matt. And you can see that Honeywell shares currently up over 2% on that plan.
Right. We'll continue to talk about that stock and that spin-off story. I wanted to talk about valuations because, to me, they're looking pretty high. This is the S&P 500's forward 12-month price-earnings ratio. It's about 22 right now. And, yes, we're not at the COVID highs after the huge bounce we had in March, but we're still the highest level other than the pandemic era on this chart. And if you took it all the way back to the 90s, Katie, of course, we would see the bubbles of 99 and 2000 a little bit higher. But for the rest of history, right? I mean, this is a very high valuation.
It is very high, but I love stats like these because they truly are like an ink blot test. I mean, you can fit it to any narrative. If you're bearish, you can say, for sure, that looks very expensive. I don't want to touch it. If you're bullish, you would point to 1999. You would point to the early 2000s and say, well, there's more room to run here.
Yeah, absolutely. We're going to talk about that today with our first guest. I want to point out, though, that right now in Greenwich, Connecticut, the Greenwich Economic Forum is underway. Our own Sonali Basak is there. She's speaking, as I said at the top of the show, with Ray Dalio, Bridgewater Associates founder and CIO mentor. We'll bring you more of that conversation in just a few minutes, but you can also watch it if you've got a Bloomberg terminal on your desk. Just type Live Go on the terminal. Let's bring in, though, Emily Bowersock-Hill. She is CEO and founding partner of Bowersock Capital Partners. And Emily, Katie and I just talking about these valuations. If you just look at the plain vanilla PE, we're at 26 right now. And yes, we've been in the 30s, right, historically, but it's still much higher than the 10-year average. Doesn't it feel a little bit stretched?
I do think valuations are stretched, especially in the mega cap growth and technology sectors. But as you just pointed out, we're at PE levels last seen in November of 2021, which was the height of the last bull market. But we're not even approaching the PE levels that we saw in 1999, 2000. So we haven't seen prices decouple from fundamentals. And I would say the other thing that we need to keep in mind is that those high PE ratios are driven in part, or in large part, by a very concentrated group of stocks. So there is room for this rally to broaden out across sectors, and there are parts of the S&P 500, if we're using that index, that don't have those PE ratios. So I actually think that that is potentially a tailwind. Now, I do think we're going to experience some volatility in here in October, and especially in reaction to the election if we don't have a decisive outcome. So I'm not thinking that we're going to, that these PE ratios are going to continue to climb unabated. But I think they're not high enough to derail what is fundamentally a bull market.
All right, so if you see us going higher, Emily, What drives us there? Is it just, earnings season being strong again? Is it the presidential election, maybe the outcome, or the fact that, maybe we get it behind us without a fight? Where do you see the impetus for another leg higher?
Good question. I actually don't think that it's going to be earnings season that's going to drive the bull market higher, because I think expectations are modest, and I think we'll see some modest beats. But in general, I don't think that's going to be the catalyst. I think the catalyst is going to be some kind of decisive outcome for the election, which we may not have. I mean, historically, the fourth quarter in an election year is a strong quarter, and we're set up for that because the third quarter, which is historically the weakest quarter of the year, actually surprised everyone by coming in relatively positive in most asset classes. So I think we're set up for a good end of the quarter. I think the jobs markets helped. The fact that we're in a rate cutting cycle helped. That being said, there's shades, at least geopolitically speaking, there's shades of 1939 and 1913, and not to be melodramatic, but we certainly are seeing heightened geopolitical risks, which could be a significant setback. But again, I don't think it's earnings. I don't think it's going to be PE ratios that slows down the bull market. I do think that we just need some certainty about who the next president is going to be and who is going to control the House and the Senate. And once we know that,
It took my brain a second to get those date references, because I was thinking about, what is that, the end of the Depression? Is that the beginning of the Fed?
What was the stock market doing in 1913?
But I think, Emily, you're referencing the beginnings of world wars.
Yes. And I'm trained as a historian, so I tend to think that way. And I think that my point really is not that we're about to go into another world war. I want to be clear about that. My point is that, we have got some major geopolitical issues out there. It's not just the war in Ukraine, but we have a war in the Middle East that could continue to widen. And I think that China is in a major jam. And I think, the volume or the extreme nature of the stimulus that China just unleashed shows that they finally recognize that they're falling into a deflation trap. And an autocracy like that, I would say that that's a heightened risk to the rest of the world. We need China to be stable.
And Emily, given that you do have, that historian history, I mean, the comparisons to 1913, 1939, of course, are pretty sobering, but just approaching it from the investing standpoint, if you even can, I mean, what is that sort of backdrop? If you extrapolate that into a portfolio, what do you do right now?
You do nothing, because actually the stock market doesn't tend to react to geopolitical events in the long term. You could get a short-term reaction. I think if instability in the Middle East, for example, were to drive the oil price over $100 a barrel, then we would see that would be increased inflationary pressures and could be a drag on the stock market. But I think as long as energy prices stay in this range, you'll see reactions from the market. But for the most part, again, this is not something that you should not be changing your portfolio strategy based on what you think might happen in the election or what you think might happen in the world.
It's really interesting.
It never works.
I mean, we talk about it all the time, basically. How do you hedge geopolitical events? We were talking about it in the context of oil last week, and then you take a look this morning, Brent is already back below $80 a barrel. So your point, well taken there. Let's dig into what else you said, though, about what a catalyst for this market would be. I was interested to hear you say that actually it would be getting past the election, because we talk to people all the time who tell us that in the grand scheme of things, the election is just another risk event and it doesn't matter that much, to focus on what the Fed is doing, focus on what the economy is doing, and focus on corporate America. But why, in your view, is it the election that is going to be the catalyst here?
Well, the market doesn't like uncertainty. And I would say that both a Trump presidency and a Harris presidency neither one is suggesting that they might cut back the deficit spending that we've had for the last 10 years. And it's that deficit spending that has pumped up asset prices. And as long as that continues, you're likely to see, this bull market continue. But I think what the market doesn't like is the idea or the possibility that we could have protracted legal battles, potentially violence. I think that's unlikely, but we saw it happen. We've seen it happen, and I think it could happen again. So that kind of turmoil is not something that the markets would react positively to. And so if that possibility were to be resolved, and we had a decisive election and then we moved on, I think that it's very likely that the market would rally into the end of the year, very similar the way it did in 2016.
Emily, we've gone 7 minutes, talking to you 7 minutes without meaningfully mentioning the Fed, which surprises me. What do you expect now that we've gotten the strong jobs number for September? Obviously, the data is going to be messier in October due to the hurricanes and the port strike, and the Boeing strike. But do you expect the Fed just to go 25 and 25? Does it matter the path as long as they get to somewhere near 3 by the end of next year?
Well, first of all, note to Fed haters, inflation was in fact transitory. So again, from a historical perspective, we saw CPI elevated for about 2 years and PCE for about 3. That was very similar to what we saw after World War II. I recognize that from the standpoint of the American consumer, 2 to 3 years feels like a long time. But from a historical perspective, again, it was transitory. So I think the Fed has done an excellent job. And one of the reasons they've done such a good job is that Chairman Powell is very adept at packaging and marketing Fed decisions in a way that investors find calming. I would expect them to cut rates twice at a quarter point each. I think this last jobs report was so positive that it's possible, and I think one of the items in that report that would give the Fed pause is the 4% wage growth. And so I think if anything, we could end up with fewer than 2 quarter point cuts, but I think that a 50 basis point cut, another 50 basis point cut is off the table.
All right, Emily, that's a good place to leave it. Really appreciate your time today. That is Emily Bowersock Hill of Bowersock Capital Partners. Meanwhile, let's take a look at this market. Different picture than what we were looking at about 24 hours ago, because you have the S&P 500, the NASDAQ 100 currently up by about 0.4%. Of course, this comes after some pretty hefty losses yesterday, so still quite a hole to dig out of there. But you take a look at the Russell 2000, also in the green, less so though. Small caps up about 0.1%. Meanwhile, let's take a look at what's moving underneath the surface. We'll do that with Abigail Doolittle.
Well, one point of relief for investors this morning, Katie, the insurance stocks and the reinsurers. We have Travelers and Progressive, both of these insurance companies, do have exposure to Florida. And as Hurricane Milton has been downgraded to a Category 4, it seems that investors are a little bit less nervous here. These stocks down significantly yesterday, the worst day in a year. And Heritage Insurance down 2.1%, still a loss. But compared to yesterday's 23% loss, the worst day ever in this company's 10-year history, you can see that it's a little bit of relief, and this company has a lot of exposure to Florida. We'll be continuing to track this story. As for one area that is down sharply, China Tech, we do have big losses here. Alibaba and JD.com as an example. The Chinese government is saying that they are going to promote growth for the company, but they stopped short of new stimulus. So after a 30 to 40% rally for these stocks over the last, let's call it 2 weeks or so, this is a big cooler. We'll be taking a look at this reversal and how far it may go. And then finally, of course, JD.com, one of China's big internet e-commerce stocks. Take a look at Amazon on the first day of Prime Day, up about 0.5%. This, Matt, after falling yesterday on a rare downgrade from Wells Fargo, the company there, saying that the AWS or the cloud business, it's not enough. Well, Prime Day, we're going to get to see soon the figures and whether or not that e-commerce part is going to be picking up some of the slack there.
How many Prime Days are there? Is there a Prime Day like every month?
I think so at this point.
It just seems like it's very often Prime Day, and I used to think it was like an annual event.
Like an exclusive thing you had to act on.
Like there was a
of.
Prime Day, the way there's like a Thanksgiving Day or an Easter.
Well, soon every day will be Prime Day. It's Jeff Bezos' world.
Yeah, all right. Well, we will continue to cover any movement there in the individual names. Certainly looking at Honeywell right now, down 3%. We're going to dive into Honeywell's plans to spin off its advanced materials business. It's the latest in a string of spin-offs that we've seen. It's cyclical. It happens. Happening right now, Bridgewater's Ray Dalio speaking with Sonali Basak at the Greenwich Economic Forum. You can also watch that full conversation on the terminal. Just type live go. This is Bloomberg.
In a way in which it's nationalist, protectionist, lower regulation.
Let's get to high interest now. We'll look at what's making headlines around the world. China said it is confident in reaching its economic targets this year and promised to further support growth. However, the country's economic planning agency held back in unleashing more major stimulus. That was a disappointment to investors looking for more fuel for the stock rally. The National Development and Reform Commission said it would continue to issue ultra-long sovereign bonds next year to support major projects, but didn't come out with a bazooka. And Samsung is issuing a rare apology to investors for disappointing results, admitting that it's grappling with a potential crisis after losing its way. The newly appointed head of Samsung's core chip business promised to overhaul the organization in the wake of the results. The Korean tech giant began laying off workers last week in Southeast Asia, Australia, and New Zealand as part of a plan to reduce global headcount. And Hurricane Milton is set to approach the Florida Peninsula as a catastrophic Category 4 storm bearing down on a region still struggling to recover from Helene's devastation. Milton's top wind speed slowed slightly, but is still 155 miles per hour. With winds that intense, Milton is capable of collapsing homes, flattening trees, and triggering power outages that could last weeks or even months. Katie?
Well, as we keep saying, spinoffs are so hot right now, and this time it's Honeywell that's considering a spinoff of its advanced materials division as the industrial conglomerate looks to streamline its holdings. Joining us now is Bloomberg's Bailey Lipschultz, who covers spinoffs and everything else. I feel like we change your title every single time because you just actually cover everything. In this case, though, we're talking about spinoffs. What's going on with Honeywell, and how surprising is this, or was it expected?
It's not necessarily surprising, Katie. Just looking at deals they've struck within the last several months, they acquired Carrier Security business for $5 billion. They also bought Air Product and Chemicals, LNG, process technology and equipment business for $1.8 billion. Honeywell is a company that enjoys acquiring and separating their businesses. You look back to 2017, 2018, they spun off a few companies back in 2018. So it does seem like with kind of current management CEO Vimal Kapur, excuse me, can't speak, trying to reshape the company, trying to get back up and kind of catch up to peers. It's underperformed the S&P by about 20% year to date.
I bet those guys would have difficulty saying Lipschultz.
Yeah.
You know? Let me ask about these spinoffs. You know, I started here a long time ago when companies were doing the same thing, getting down to their core business, selling off peripheral assets. And then, you know, we went through a period of building those conglomerates back up. And now, you know, it's like the pendulum just swings on this. How many companies are doing this in your universe?
We've seen a number. So when we look back at, call it the last 18 months, you've seen GE break up into three companies: GE Health, GE Vernova, and GE Aerospace, which is now their aerospace company. GE Vernova up 100% since that spinoff happened. We've seen a number of other companies. You look at the breakup between Kellogg, now WK Kellogg, and Kellanova. You see Veralto coming out of the Danaher portfolio, Vestas being carved out, I believe, last year. So we're seeing a lot of these blue chip companies, Matt, maybe slower growth. They're wanting to kind of invigorate investors that can kind of buy into their growth profile. That does seem like the Honeywell deal right now is to strip out a company that generates solid margin, solid EBITDA, but not really fast growing, which investors want right now.
And Bailey, we only have less than a minute left with you, but given that you do cover everything, let's talk about this report coming out from Hindenburg Research saying it's short Roblox. Of course, Bloomberg News has reached out to Roblox for comment, but it seems like they were looking at key metrics that Hindenburg says that Roblox inflated.
Yeah, and that's just according to the report. Again, Hindenburg, Nate Anderson, makes money when these stocks go down, and he has a pretty tremendous track record. As you mentioned, potentially arguing that the company inflated user metrics to investors. The one thing that does stand out, again, favoring growth over child safety. That's something Bloomberg and a number of other outlets have kind of beat the drum on as it relates to Roblox. One thing to just keep in mind, the stock is down closer to 70% from its all-time high back in 2021, down 13% from a September 25th high. So has had a rough go of it, and we have seen a number of skeptical reports from third parties over the last few months as it relates to Roblox.
Wow, Hindenburg used the term pedophile hellscape
For kids, yeah.
Yeah.
That's in the
to
tweet.
describe Roblox. That is inflammatory. All right, thanks very much for joining us, Bailey. Very interesting news on those companies. Happening right now, speaking of interesting, Bridgewater's Ray Dalio speaking with Sonali Basak at the Greenwich Economic Forum. You can watch that full conversation on the Bloomberg terminal. Just type live go for more of the founder of the biggest hedge fund in the world. You might want to hear what he has to say. This is Bloomberg.
Those provinces own loans. So there needs to be, I've been through these many times, 4 times in the United States, many times globally. There need to be 2 things. There need to be a debt restructuring, which will happen along those lines. And there needs to be a monetary policy in which interest rates are lower than the nominal growth rate and there's real interest rates are lower, and that there's a disincentive to hug money that right now there's almost a pushing on a string because they're holding that. And what classically the bottoms, like our 2008 bottom or any of those major bottoms, take place when the assets get very cheap and
All right, 4 minutes to go until the bells ring. You can see we have green on the screen behind me. The S&P 500 up by about 0.4%, a little bit more on the NASDAQ 100, but of course, that's after yesterday's wipeout. So we'll see if sentiment can hold. Coming up after the break, a live exclusive interview with JPMorgan's Jamie Dimon. That's up next. This is Bloomberg.
Moments away from the start of trading, futures indicate a rally. This is Bloomberg Open Interest. I'm Matt Miller. Take a look at the gains accelerating into the open right now. 0.5% on S&P futures, a little bit more than that on NASDAQ 100 futures. The small caps gaining about 0.2%. There you hear the opening bell down at the New York Stock Exchange and at the NASDAQ market site. You have a couple of IFF ringing the open bell at the New York Stock Exchange. Victory shares ringing the bell at the NASDAQ. If you look at the averages, we could make back more than half, or let's see, actually less than half of what we lost yesterday because we were down almost 1 full percent. So we have to add more than that to get back. And Katie, what are you looking at right now in terms of the live moves?
That was some good math on your part, and you're absolutely right. You take a look at the gains this morning, up about 0.5% when it comes to both the S&P 500 and the NASDAQ 100. Still a pretty large hole to climb out of. You consider the S&P 500 down 1% yesterday, but 1.2% on your big tech index yesterday. But of course, progress today. The Russell 2000, of course, joining in on the action, but to a lesser degree. The Russell 2000, your small caps currently higher by about 0.1%. Meanwhile, let's take a look under the hood, and we'll start with Supermicro, extending gains from yesterday after announcing it delivered 100,000 GPUs to power artificial intelligence factories. That's believed to be billions of dollars in orders. This is an interesting stock because remember, Hindenburg, which Matt will talk about in just a moment, shorted this stock a little while ago, and it's been a rough ride, but some good news for Supermicro. Meanwhile, let's also keep an eye on Pepsi here, which cut its revenue outlook for the year as higher prices across the country hurt consumer spending. Traders not really sure what to do with those results. The stock is currently, I'm going to call that unchanged, Matt.
All right, yeah, it looks pretty unchanged to me. Let's look, though, at one of the stocks you talked about earlier, which is being almost decimated. The definition, of course, reduced by 1/10. This is Roblox, plummeting after Hindenburg announced it's short of that stock. And as Bailey Lipschultz was mentioning, when Hindenburg puts out these reports, it profits off of a drop in the stock price, so it's trying to drive the price down. And right now it is being successful. Let's take a look at some of the Chinese stocks also that suffered at the start of trading in Shanghai after a week-long break. Remember, we had that huge rally, and I think Goldman Sachs was out saying that Chinese stocks could go another 20%. But right now, we're looking at big losses for Alibaba, Yum China Holdings, as well as Baidu, because you didn't get the big government stimulus that we were hoping for. Bloomberg's Abigail Doolittle has a little bit more on the China moves for us. Abigail?
It seems we're back in an era of more, investors wanting more after the big stimulus just 2 weeks ago that sent China tech stocks up 30 to 40%. Today, down nearly 7%, the worst day since March of 2023. So pretty dramatic reversal here. We don't know how far it will go, but that uptrend, those buyers have been reversed. And here are some of the other losses. PDD Holding down 7%, Bilibili down about 13%. And then take a look at the casino stocks, the gambling stocks, both down about 4% or more. Of course, they have lots of exposure to Macau. So the idea that if more stimulus isn't going into the economy, it's not going to be going to the Chinese consumer who could then gamble it. Relative to the China tech stocks, this is the RSI, or a momentum indicator for that index. Yesterday, it had been close to 90, or really overbought. Well, the reversal's been dramatic. It is now no longer in that overbought territory, Katie, so we'll be keeping an eye on this and whether or not we're going to have a reversal similar to times past, right back down to oversold as they go up and then back down.
All right, Abigail Doolittle, thank you so much. Let's go now to London, where JPMorgan Chairman and CEO Jamie Dimon joins Bloomberg's Lisa Abramowitz for an exclusive interview. Lisa.
Katie, thank you so much. Really appreciate it. I am here with Jamie Dimon at the Techstars conference at the Novo Hotel in London. And we're going to get into a bunch of different things, a lot of the questions that people have. But one main question is, we're seeing this sort of explosion in tech. A lot of people are pausing it. How are you sort of seeing the advancements that are most important so far? And going forward, what's most exciting? What's the most exciting for you?
Yeah, so first of all, welcome everybody. Thrilled to be here. First of all, you got to look at tech in the big picture. It's been changing society for hundreds of years. With agriculture and printing and steam engines and electricity and the internet. And tech grows in itself. The internet caused A, B, and C, semiconductors, and Gorilla Glass caused the iPhone. And so this is just another wave. We're here in London because we call it the tech conference here, but it's also diaspora now. So if you went back 10 years, it was mostly in the United States and concentrated in Silicon Valley, Boston, New York. Now it's everywhere. We have a tech center in Berlin, Glasgow, Edinburgh, which I think is great. You have more innovation taking place. I think it's really important for Europe. And obviously the thing now is all about AI, which I think is real and is going to change an awful lot of things. Can I just mention one other thing?
Please.
There's always been a fear of tech that's going to take away jobs, but you got to look at the big picture. Sometimes it does, but in the big picture, it is why mankind has gotten better and better, lives longer, GDPs go up, productivity goes up, health gets better, work hours go down. So people have to keep in mind the benefits are huge. We probably have to find a better way to help the people get hurt by it.
So you talk about the people who are getting hurt by it, and in a previous interview you were talking about how it's going to reduce some jobs and it's going to create others. Yeah. Which jobs do you expect to get eliminated and which jobs do you expect to get created?
Yeah, we don't really know yet. We shouldn't put our head in the sand. We know it's going to be true. So a lot of jobs, your job will be enhanced. You'll get more research, more questions, you'll have like a real super assistant, chief of staff on your shoulder when you wake up, but you're still going to be interviewing people. Other jobs, it will handle error rates, or, it already hedges our trading equity floors. It's already been used for risk, fraud, marketing. Hasn't really eliminated a lot of jobs, but it created effectiveness in terms of productivity by, reducing fraud losses. And then if it changes jobs in operations and elsewhere, we'll deal with it. We have turnover 20% a year. We love to retrain people, redeploy them, re-educate them. And so I'm not worried about it. And if it works for the customer and the client, we can kind of do more. That's the other thing. For a successful company, if you're growing and expanding, you're actually almost always getting jobs. So, to me, I want to have a successful company, and we'll deal with whatever the downside is of AI.
So I was speaking with another head of a major U.S. bank who was saying that he expects his bank to keep growing in terms of business, in terms of assets, but stay the same size when it comes to staff. Do you feel the same for JPMorgan?
I don't really know, to tell you the truth, and I don't try to predetermine that. So if you look at what we're doing, we're still opening branches. We're still opening branches in cities around the world. We've added 1,000 people in AI itself. We're adding people and data scientists, journey to the cloud. We have 44,000 engineers. So I think what you're going to see is some down, some up. In general, if we're a growing company, I would expect to go up a little bit, in general.
Typically, the Techstars is a conference where a lot of founders start to test the waters for IPOs, potentially look to go public. There's been a deterrence to really going public as quickly as in the past, particularly for tech companies, just because there's so much private capital out there. Do you still see that? Is that a structural change, or is that something that's cyclical, just having to do with rates?
It's a complicated subject. Yes, there's private capital, and I think it's a good thing that people can raise money in the private capital markets. But it's a little odd that public markets are quite elevated, and IPOs haven't come up very much yet. So, but part of it is they have access to capital. Part of it is they're waiting. Part of it is they're reducing their own cash burn. They don't need as much cash. So it's a whole bunch of reasons why they're not going public. But I think eventually you do need healthy public markets to have people liquefy their positions, which all the venture capital, I just had lunch with a bunch of venture capitalists, they all are going to want to do and actually need to do at one point.
So do you expect that to pick up in the near future, or do you think it's going to remain muted for the foreseeable future?
I don't know. I honestly don't know. I think it may very well stay muted because markets may come down as opposed to just go up endlessly. And they may find other sources. So when I speak to a lot of private equity and private venture and stuff like that, they tell you they have more non-public sources. I do think it's very important that our policymakers understand, because even here in the United States, we've made it hard to go public. We've eliminated research on smaller companies. The costs are much higher. Those litigation expenses are higher. Filing with the SEC is higher. So I think it would be really incumbent upon us to try to make it easier and cheaper to go public, allow more risk to be borne in the public markets, and we got to figure out a way to do that. And we actually have 10 takeaways from lunch, which I want to take a good look at.
So that raises a question of where people are going public. And we're here in London, which has lagged behind a number of other areas, particularly New York, and has lost clout in other areas too, especially since Brexit. Do you think that this is just a momentary blip, or do you think that just on a broader level, London is kind of losing a bit of its clout as a major financial center?
And so I think, first of all, I love the fact, if you listen to the current Labour government, they're talking about growth, investment, markets, capital markets, and they do need to do those things to help it recover. If they didn't do those things, no, I think it'll become more permanent. And a lot of people, they go to the United States, there's more liquidity. It's easy to do. Or they have a lot of business there, which also making this a great business environment will also help companies going public here. But right now, the NASDAQ, the New York Stock Exchange, they're just more attractive places to go, and we'll see how that pans out. But I think it's important. We want to help them do better here. I'm not in favor of just advancing in the United States at the expense of Europe. But I do think that Europe needs to focus on, Mario Draghi's report. There are a lot of things in there that they need to do to get productivity back and growth back and markets back. They need the capital markets union, for example, which they've been talking about for years. They actually do really need it to foster growth around European countries.
On a broader level, just aside from the London market, what kind of activity do you see in the pipeline for fourth quarter? Do you see a reluctance by companies to really engage with major actions because of the election, because of potential volatility, because of geopolitics, or do you see it really ramping up?
Yeah, so I've always, we always talk about backlogs, and I always tell my own people, be careful, because backlogs tend to grow and expand and then stop. There's a pretty good backlog growing of IPOs of companies. Whether it happens or not is a different thing. And M&A, yes, I do believe, I can't prove it's more anecdotal, that it's tampered quite a bit by not the election, maybe the election, but by rules and regulations. And you talk to a lot of boards of directors here. They talk about is the risk capital there? You can take the risk. They want to be very conservative. In the United States, it's more about can you wait 18 to 24 months to close a deal? That creates a lot of risk for a company. Particularly if you go to banking, I know a lot of the banks. I think they should be allowed to do deals. They're very, very reluctant because they can't wait. One of the last bank deals in the United States took 3 years. And I think if I remember correctly, there's a 90-day regulatory requirement. Well, obviously that's not taking place anymore. And we do have to fix these things. You want an active, healthy M&A market.
Just quickly, if policy...
And they're not all bad for competition, even though that, I think it's true in certain cases. But we've just become like an anti-M&A country, and that's a bad idea.
Okay, just let's say that there's somebody else in charge of the FTC, and there are some different kinds of rules and sticks that people have to advance over. How much consolidation do you expect in the banking industry?
So for the FTC, and I want to make very clear about this, they say to a hammer, everything's a nail. They're a little bit like that, but it doesn't mean they aren't right about certain things they say. I just want to separate that. Look, I think there are 4,000 banks in the United States. They're all in a different position. You could be a very profitable community bank. So I don't think the idea you have to merge is true. But if you're competing in a certain business for certain clients and certain sites, you may need economies of scale. And they should determine. So you do need consolidation. A lot of the mid-sized banks want to do it. They shouldn't be hampered. And they would tell you, if I can't do it, you're basically ceding the ground to JPMorgan. And I think that's unfair. They should be allowed to merge. Their boards of directors should be allowed to make that decision based on what they think is in the best interest of the shareholders. This notion that government should get involved in every single little bank deal, I think is just wrong. And, they're adding social values to everything they do. It should be about safety and soundness. And a board of directors that says we need to merge, or we want to merge, probably means they're heading for a safer and sounder bank. That's their desire. You can give a lot of examples where it doesn't work. It doesn't mean it shouldn't be allowed. And I think we've got to be a little more open about letting these things take place and letting them take place quickly.
Aside from just some of the regulatory overhang, there is this question about how much, in general, the markets are going to open up, and a lot of that has to hinge on the economy. You mentioned earlier that you are more pessimistic about a soft landing. I think you gave it a 35% probability back in April. Do you still think that, or do you think that the probability has gone up with some of the good data that we've been getting?
There's important. I'm not talking about forecasting 2025, and I just think there's a lot of moving parts. A lot of things in the future which are inflationary. The most important thing taking place is these wars overseas, geopolitics, the terrible humane suffering, but also the a bunch of these countries acting in cahoots against Western interests, against Israel, against Ukraine, against the United States. And that's really serious. So I look at a long amount of serious things. Soft landings are hard. I hope it happens. I don't know. I just wouldn't count my eggs in that one.
Do you think
and markets are open. When you say open, they're very, values are high. They're not low. Both equities and bonds, credit spreads are very low. So they're open, but people are saying they're not open for IPOs. So some IPOs, when we just did one of the largest ones of the year, like last week, they're open for those who the market wants to buy today. But don't assume that they're not open. And, sometimes people would go public, they don't like the price. That's a very different thing. And you should think twice about that. When you think you know what a company's worth much more than the market might know.
That maybe it's an assessment of what you're looking for rather than the actual market being closed.
Exactly.
You said that there are a lot of inflationary things that are coming down the pike. Do you think that it was a mistake for the Fed to cut by 50 basis points?
No, actually. You got to separate the here and now. Inflation has definitely been coming down. They don't want to go into recession. Unemployment has been going up. They raised rates. They were late raising rates, but they raised it very high, rapidly to 5%, which I think is the right thing. And they're right to take their foot off the gas in that one. I don't think it matters that much, 50, 25, honestly, but I think that was okay. If inflation comes back, I'm looking at future things. The remilitarization of the world's inflationary, the fiscal deficits of the world, particularly the United States, are inflationary, the green economy is inflationary, demographics are inflationary. It's very possible energy prices down the road, I'm talking about 2-3 years, will be inflationary. Those will hit later. They should react at that time to those things, but I don't think you can anticipate that. We don't know that that's going to happen.
I'm so glad you brought up the deficit. I watched the Treasury auctions. There's another 3-year one today. I watch them every time wondering, are we going to start seeing disruption from some of the concerns that that you bring up, but also every single investor who I speak to says the same thing. Are you surprised that the market hasn't priced in a higher structural deficit in the way of higher yields or at least more volatility, at least at auctions?
Yeah, well, I have a lot of comments on that one. Commodity markets often don't price things in until they actually happen. And so it hasn't happened yet. The higher inflation, the higher structural stuff, even though the deficits are there, there's also sentiment, inventory, supply and demand of capital goods. So it's very hard to say. But that's why I think that longer rates may actually stay here and tick up a little bit as opposed to go down because of these huge deficits in the United States. And then the market's reacting, which the word you used of volatile or something like that. It's not always bad. I think we overreact sometimes to volatile markets, but I do think they'll happen again. Dealer inventories are very low. Banks are, the big market makers are very constrained. Not today. We have this anomaly where JPMorgan is going to have $1 trillion of cash and unable to intermediate in treasury markets or repo markets completely conservatively. because we're required to hold that cash in very, like central bank reserves, something like that. So I think when QE finally gets to a certain point, you will see that. I may be wrong. And again, if it happens, I don't think it's a disaster. It's not bad for JPMorgan. I do think policymakers will get upset. They don't like seeing that type of thing. And I think there are fixes to it. And I think they start working those fixes today.
Something that you said about how markets sometimes don't respond until an event is there.
Commodity markets.
Commodity markets.
So think of stock markets that are forecasting earnings and cash out 5 years and 10 years and always adjusting it. And they're buyers and sellers and, equity prices adjust. But if you look at commodity price action, while sometimes it's forecasting the future, it actually is looking at supply and demand today. So the most important thing is supply and demand today with some sentiment, some inventory, how quickly you can replace supply and demand. So all commodities are different, but think of the treasuries a little bit as a commodity.
Well, do you think that treasuries, especially if you look at it as commodity, which is a wonderful way to look at it, that there is sort of a catalyst in the election with respect to realizing what the deficit could be?
Yeah, people are making charts about what everyone said and what it might mean for the deficit. What they said and what they actually do and actually happens are completely different things. I'm not going to worry about that. I think what you should worry about is the deficit today is 7% of GDP. When Volcker was around and we had very high inflation, it was 3.5%. The debt to GDP is 35% back then, 1982. It's 100% today. The deficits today, the biggest peacetime deficit we ever ran. Deficits by their nature are inflationary. And at one point we have to deal with this. I mean, I would beg the government to set up a powerful Simpson balls type of committee authorized by the Congress, up or down vote. It's probably the only way to do it. The other way to do it is wait until there's some kind of disaster in the market, and then you're kind of forced to do it at the wrong time. And I don't know when that might be. Will it happen next year? Probably not. But can America afford 120% debt to GDP? Probably. But should we wait for that hockey stick to start? I don't think so. I think it's just a bad way to run risk.
So you mentioned government. Libby Cantrell of PIMCO, she runs public policy over there. Every time she comes on, she tells us that when she talks to clients overseas, she has to tell them, no, Jamie Dimon still isn't running for president. You get that question so much. Does it annoy you or does it flatter you?
It's more annoying than not because I can't run for president, and there was no opening. I mean, there's no way that it was even possible. So it's a little flattering, but, I just want to help our government do the right stuff. I think there are a lot of things to do to make America far better off. And particularly, because I've mentioned this many times, a lot of things we've done which I think are bad, whether you're Democrat or Republican, we support, it's often done in the name of good, have hurt the lower 20%. They're dying younger, their income didn't go up for 20 years, they're the ones who have more crime in neighborhoods, their schools don't work. We should acknowledge that as citizens and do something about it. Like I said, a lot of policies put in place have the exact unintended consequence, and that's who they hurt. Like, for example, growing the economy well, the people who help the most at the lower end. And I think we have to be very clear-headed about how we can accomplish what we want to accomplish to lift up all of America.
You haven't endorsed a candidate, and I wonder why. Is it because you think as the leader of a big company you've got to work with anyone, or is this just that you can't decide this particular time around? I
will decide, okay, and I will vote. I reserve the right to do whatever I want. Okay, I'm a citizen. I can vote. I can say what I want, and stuff like that. I've never been in the practice of endorsing candidates, and so. But I'm thinking through what I want to say or do or something like that.
In a recent Washington Post editorial that you wrote, you talked about how you think it would be important for the next president to have a private sector individual at the cabinet level to really advise.
Like half.
Half?
Yeah.
Okay, which positions do you think should be?
I mean, look, I look at the government. The American public needs and deserves very competent, effective government. And if you go around, they don't believe that's what they have. And, so people have all these things the government should do, but a lot of the things the government does, it doesn't do particularly well. It does some things particularly well. It does a lot of things only the government can do. But we have to be, again, cold-blooded, clear-headed, pragmatic about what works, doesn't work. And over time, there have been less and less people in government who were in the real world. You may think whatever you want about, I'm not blaming economists or teachers or stuff like, or lifetime politicians. That's not the same thing. And there are lessons in the real world. Even FDR, when he's getting closer and closer to World War II and needed to start building tanks and bridges, he took the people he'd been excoriating for years, the heads of GM, GE, DuPont, and got them back. I need you to set up these production boards and grow the, do these things. So it's about growing the economy. It's not about putting business people there. I think we shouldn't insult each other as citizens, try to understand each other. And I think it'd be great if the next president, they really want to, what's that word they say, unify, put someone from the other party in your cabinet, which, by the way, is what Eisenhower did. And that whole op-ed kind of came out of Eisenhower. He got the right people there. They studied the issues. They got the policy right. He never blamed people. He never insulted people. He never, he was always civil, and which I think is a better way to be. He didn't denigrate the country, didn't denigrate classes of people. And so I just think that's the better way to be. And it's a more unifying leadership than, yelling and screaming at each other.
If someone theoretically were called upon as a business leader, would you suggest that they go?
Yeah, it's up to them. I wouldn't suggest they go and not go. It's their life and how they think they can contribute to stuff like that. So,
a major focus for you in your recent letter to investors and just in interviews has been geopolitics, and the situation is pretty dire. And I wonder if what you're telling clients, what they're doing, how they're arranging in preparation for potential escalations in a whole bunch of different hotspots.
Unfortunately, I go to a lot of things and people like, tell us the positive news. What's the good spin out there?
I was getting to that.
I don't do anything like that. The truth is the truth is the truth, and the truth today is pretty ugly. And we have this war now. Almost 1 million casualties in Ukraine. The Ukrainians say that 20,000 children have been kidnapped and sent to Russia. It's quite clear that Russia, Iran, and North Korea are acting in cahoots. That China isn't kind of part of that, but they're aiding and abetting Russia. China and Russia have spoken about dismantling the world order set up by America and the Allies after World War II, which have been quite successful in keeping peace. They want to do it differently, and that's their right. I don't think it's a good idea for the Western world. And of course, the terrorist acts in Israel is being attacked, basically on 3 or 4 sides. This is tough stuff. American warships are being attacked every day in the Red Sea. The head of the FBI just said the terrorist threats internally and externally to the United States have never been higher. I think there was a lesson on when Ukraine was invaded. The world isn't a safe place. We've got to get rid of the illusion that it's safe and somehow peace is at hand. So we need a very strong military, which means we have to spend more money, at least every analysis I've ever seen for that. We need a very strong economy. We have to subordinate some of the stuff we do to national security. And we have to engage much better the allies in trade, finance, development finance, and things like that if you want to hold the world together. And so, yeah, I think this is the most important thing. For dwarfs whether we have a soft landing or a modest landing in the next 12 months. That, to me, as a business person, almost all of us in business have dealt with that many times. That is not a big deal.
I guess, how do you then advise a potential client about what national security is? Is it a car? Is it AI? I mean, basically, how do you prepare for the changing world that we live in?
Yeah, so this is a very important question. So first of all, in terms of managing risk, when you look at the potential outcomes, I mean, all business should look at a range of outcomes and try to be prepared for them, whether or not they think they're going to happen. And then, could war affect the global economy? Absolutely. It can cause inflation and no growth. It may have no effect, but you got to be prepared for those things. And then on strategy specifically, we've actually hired Paul Henley, a former U.S. Army national intelligence guy, forming a group, working with our research people, internal people, to answer exactly those questions. What is national security? Jake Sullivan talks about the small garden with high fences. What's in the garden? What's related to the garden? How would you do that? A lot of companies are still looking at their own supply chains. They would say, no, I get these components from Mexico or Vietnam, but inside that component is a very important one from China. So it's going to take a while, but every country, if it's national security, has the right to say, this is what we're going to do to protect our national security. And so we need work to do. And then the related, I call it mercantilist behavior. People are getting upset at China about EVs and lithium and solar. If it's unfair competition, that's a different issue, but it also needs to be addressed.
Jamie Dimon, unfortunately, we're out of time. It has been a pleasure speaking with you. Thank you for taking the time with us. And now I'm going to throw it back to you.
All right, Lisa Abramowitz there speaking exclusively with Jamie Dimon. This is Bloomberg. All All right, we are 30 minutes into the trading day. Welcome to Bloomberg Open Interest. I'm Matt Miller.
And I'm Katie Greifeld, Sonali Basak on assignment. And coming up, Jamie Dimon sounds off on AI, rates, the election, and more. We'll bring you highlights from that exclusive, wide-ranging conversation ahead. Also, feeding the AI boom. We speak with the CEO of uranium producer Cameco as big tech turns to nuclear power. And Hurricane Milton is forecast to be extremely dangerous when it makes landfall in Florida tomorrow. We're tracking the storm's path and potential fallout. Meanwhile, 30 minutes into the U.S. trading day, let's get a check on these markets. And it's pretty favorable outlook right now. The S&P 500 up 0.6%. That is after yesterday's 1% decline. The Nasdaq 100, big tech leading the way here. You can see the Nasdaq 100 currently up about 0.9%. The bond market pretty well behaved after yesterday's fireworks. The 10-year Treasury yield currently up about 3 basis points. We are above 4%, but hovering around these levels. Meanwhile, Matt, let's talk a little bit more about Jamie Dimon. Of course, that exclusive conversation with Lisa Abramowitz in London. There's a lot to dig into. I thought what he was saying, though, about the public markets. It's odd that, of course, you have the public markets at all-time highs with the S&P 500. You haven't seen IPOs pick up in a big way. You haven't seen M&A pick up in a big way. And a lot of that he blamed on regulation.
Yeah, he said, for example, when he talks to board members at companies, they say they want to do a deal, but the question is, can they wait 18 to 24 months to do it? Because of regulatory hurdles that they have to clear, it takes that long. I thought it was interesting that he said he thought mid-sized banks should be able to merge. Obviously, one would be buying the other, so the word merger is kind of a PR term. But it is interesting because we have, what, 5,000 mid-sized banks in this country? And I also thought interesting because if enough of them came together, they could compete with him.
He didn't say that JPMorgan should be allowed to buy more mid-sized banks, like you said, saying that they should be able to merge. But of course, regulatory hurdles in the way there, and that maybe explains what we're seeing in the IPO market as well. It was fascinating. I mean, we haven't even gotten to what he said on AI, but
the AI, right. I mean,
it's real, he said.
It's real, and they have 1,000 AI employees. I don't know what that means.
Are they robots? Are they real-life
programs?
humans?
I'm not really sure about that.
I don't know.
The political stuff was fascinating. He says he will decide. He is going to vote, and he's still thinking about what he wants to say about the election. So maybe he will come out and endorse one candidate or the other, is what he implied to Lisa. He also said he thinks half of cabinet positions should be people from public companies.
Perhaps the CEO of an enormous bank. Perhaps.
Yes, that could be someone who could help make America better.
That's what he said.
Yes, not great again. He didn't say that. He did say that he doesn't think a presidential candidate should be someone who is insulting, who blames people, who's denigrating the country. I don't know who he's referring to. But let's get to something else here. KPMG's global head of clients and markets, Regina Mayer, joins us. And I just want to talk, first of all, about the regulatory issues, Regina, that Jamie was talking about in the U.S. He almost seemed to say it's worse here than it is in Europe. The clients that you have to deal with, how much of the problems they face every day are in regulation?
I don't know that regulation creates such a major focus that it prevents progress from happening. I do think his point is quite valid that there are regulatory hurdles to clear for M&A. And we are seeing two things, both it's the regulatory and political obstacles that are coming into play, but there's also a bit of an anti-corporate sentiment. So it is curbing some of the larger cross-border deals that, frankly, more capital could be applied if that environment was more, you could more smoothly enact that environment.
Well, talk to us a little bit more about, the CEOs that you speak to. What's top of mind right now? I know that you recently put out your global CEO survey. I mean, what were some of the main takeaways when it comes to the here and now?
So a couple key takeaways for me, Katie. One is that they're still quite positive about the overall growth prospects of the economy. 72% believe that the economy will continue to grow over the next 3 years. They're also focused on risk and supply chain and operational risk. Top the charts for what they're focused on, edging out geopolitics, which made #1 on the list for the first time ever last year. But if you think about it, supply chain and operations are business manifestations of geopolitical challenges. I also thought what Jamie Dimon said about your supply chain, it's not just where the core components come from. You have to look at all of the different subcomponents in whatever widget that you've got within your supply chain, and where do they come from in the supply chain? So those are top of mind. And then the last thing I would say is a lot of our CEO clients are just trying to tune out the noise and focus on the things that they can control. And that's why you see a lot of cost discipline, which I think is going to reflect in some reasonably strong earnings as we come into the Q3 earnings season.
In terms of CEOs' responses to the geopolitical issues, because Jamie said that's the most important thing to deal with, and I think for us all as humans, it is. You want to put an end to wars and killing and the kind of suffering that we're watching. It doesn't seem to affect markets as much. Regina, what do the CEOs that you talk to say about geopolitics?
It's definitely front and center in their minds. I think it was interesting what Jamie said about the person that they've hired and how they're creating more of an internal capability. We do see a lot of our clients focused on strategic risk, geopolitics, putting that in the boardroom, making that part of the C-suite agenda. And that's not as common as it would have been 24 months ago. So I think that's how they're confronting it. But then they're also focused on how do we make things more efficient. They're betting big on AI and talent. That was another big finding in our survey, with 64% of the CEOs saying AI would be a focus. So geopolitics, it's part of the conversation in the boardroom, but it's not something they can impact directly. So they need to be aware of how it will impact their business operations, and they're focused on getting on with the businesses at hand.
And I'm looking through your notes here. Of course, we just heard from Jamie Dimon, as we keep mentioning. He was talking about the M&A landscape, about how basically regulation has been holding some of that activity back. And you're certainly seeing that in the IPO landscape as well. You mentioned in your notes that you're expecting to see a bit of a pickup here. Walk us through that call and what could change.
Well, we are seeing more certainty building, some of the uncertainty around the election cycle as we get toward the back end of 2024. I see a lot of that activity calming down. And we see that there is so much dry powder available, and it is largely in the private capital hands. And we just think that they cannot wait any longer before they put that capital to use. So we're still projecting that 2025 will see a pickup. You're already seeing it in some sectors. The sector that's in my backyard, energy, seen some very big deals. But we think that that's going to continue into 2025 and that we will see a pickup. I don't know what that means for the IPO market, though, but we're definitely going to see private capital be deployed. That's our view.
All right, Regina, always great to speak with you. Really appreciate your time today. That is KPMG Global Head of Clients and Markets, Regina Mayer. Meanwhile, let's get back to these markets right now, because one stock we're keeping a close eye on this hour is Roblox. That's plunging after a short seller, Hindenburg Research, said it's betting against the gaming platform. Hindenburg said in its report that Roblox has inflated key metrics and alleged that it doesn't have sufficient safety screens to prevent pedophiles from using the platform. Roblox has responded to Hindenburg, rejecting the claims in the report, saying that they're misleading. Joining us now is Mandeep Singh, Senior Tech Analyst for Bloomberg Intelligence, of course, a company that you follow. And just set us up here, Mandeep. I mean, what was your reaction to this report and some of the allegations that are in there?
I mean, it's not that surprising, given a lot of these platforms have been questioned around child safety and, the usage that...
Mainly this one.
Mainly this one,
because not a lot of these platforms, right?
Actually, I would say Instagram and YouTube as well, but more so for Roblox because it caters to the 9 to 20-year-olds. That's their entire user base. And when you talk about a platform with an 80 million daily active users in that age group, there will be concerns around child safety. I mean, the content that they're consuming, how much time they're spending, what kind of communities are thriving on that platform. And I think that's what Hindenburg is bringing into focus, that there isn't enough content safety. And, the fact that you've got 80 million daily active users is probably inflated. And I would say there were question marks raised around, whether Roblox's market is saturated, given it caters to the young users. And they've been able to grow 20% plus on the user side for the past, 6 to 8 quarters. So clearly, they've been executing very well on the metrics, but I think what Hindenburg is saying is there are a lot of bots on the platform, there isn't enough content safety on the platform, and I think you could make that case for any walled garden out there. I mean, even for, as I said, Facebook or YouTube, you could say there are things that are going on which may not be, good from a safety point of view.
And I do wonder, I mean, what are a 9-year-old and a 20-year-old doing on the same platform? How can it cater to both of those age ranges? I have no experience with Roblox. I feel like your kids
or 9-year-olds. Yeah. Neither one of us has any experience with 9-year-olds, but I like to think that when my child becomes 9 years old, I will not let her roam the internet without any kind of, I mean, you know, parents have a responsibility here as well, but what does the company say it's doing, you know, to get child abusers off of the platform? Clearly they know, you know, Bloomberg Businessweek has written a piece saying that they're really not doing enough.
I mean, the big use case for a platform like Roblox is gaming. The reason why Roblox is different from a TikTok or an Instagram or, you know, YouTube is the kids go to Roblox for playing games with their, you know, friends or their communities. And that's where all the content on Roblox is 3D gaming. Plus, they have all the other adjacencies, which is where I think they get into trouble with the safety aspect, is there are a lot of other folks on the platform that are not using the platform just for gaming. But I think the dominant use case, the reason why, you know, in aggregate, they get 50 billion hours in a year on the platform, it's a gaming use case.
And of course, a spokesperson for the company, for Roblox, said that we firmly believe that Roblox is a safe and secure platform, and in the financial metrics we report. And of course, we're talking about two separate things here. Of course, you have the child safety concerns, but you also have the allegation that Roblox has inflated those key metrics. And when you're evaluating a company like this, I mean, talk through some of these metrics and their importance and how bad it would be if this report is true.
Absolutely. I mean, user growth, I talked about, you know, the fact that they have been able to grow users at a 20% plus clip. Anytime a platform sees a deceleration in user growth, and we have seen that with Snap and Pinterest, you know, these are more niche social media platforms, the valuations get compressed. So in the case of Roblox, it does trade at a premium, although the valuations have come down recently. And, you know, any deceleration in user growth will have an impact on the valuation for sure.
All right, Mandeep, really great to get your perspective here. That is Mandeep Singh of Bloomberg Intelligence talking to us about that Hindenburg short report on Roblox. You take a look at shares right now, currently off by about 3.8%. Of course, we had been looking at losses of about 9.4% for Roblox, so coming back a little bit there. We're going to continue to keep an eye on that one. And coming up, we'll talk about Jamie Dimon speaking on the sidelines of the Techstars conference in London. We'll bring you part of that conversation up next. This is Bloomberg.
Let's get now to high interest and look at what's making headlines around the world. Hurricane Milton is set to approach the Florida Peninsula with winds up to more than 150 miles per hour. At that intensity, the storm is capable of collapsing homes as well as flattening trees. Obviously, it will also likely trigger power outages that could last for weeks or even months. Governor Ron DeSantis has declared an emergency in 51 counties, and residents in Tampa Bay have been told they need to evacuate immediately. One of the most influential academics in AI has been awarded the Nobel Prize in Physics. Geoffrey Hinton will share the $1 million prize with fellow scientist John Hopfield. The pair will share a $1 million prize for training artificial neural networks and laying the foundations for today's AI applications. And the pass rate for the first level of the Chartered Financial Analyst exam, the CFA exam, has slipped to 44%. It's still higher than historical averages and much higher than the slump after COVID-19 led to deferrals. The CFA Institute also broke the data down, revealing that half of all first-time testers scored a pass. Good luck to takers of the Level 2 and Level 3 tests. You'll get your results later this month. Katie?
All right, let's go back to AI, because in the last hour, JPMorgan Chairman and CEO Jamie Dimon joined Bloomberg in an exclusive interview on the sidelines of the Techstars conference in London. Here's what he had to say about the future of AI.
We're here in London because we call it the tech conference here, but it's also diaspora now. If you went back 10 years, it was mostly in the United States and concentrated in Silicon Valley, Boston, New York. Now it's everywhere. You know, we have a tech center in Berlin, Glasgow, Edinburgh, which I think is great. You have more innovation taking place. I think it's really important for Europe. And obviously, the thing now is all about AI, which I think is real and is going to change an awful lot of things. Can I just mention one other thing?
Please.
There's always been a fear of tech that's going to take away jobs, but you got to look at the big picture. Sometimes it does, but in the big picture, it is why mankind has gotten better and better, lives longer, GDPs go up, productivity goes up, health gets better, work hours go down. So people have to keep in mind the benefits are huge. We probably have to find a better way to help the people get hurt by it.
So you talk about the people who are getting hurt by it, and in a previous interview you were talking about how it's going to reduce some jobs and it's going to create others. Yeah. Which jobs do you expect to get eliminated and which jobs do you expect to get created?
Yeah, we don't really know yet. I mean, we shouldn't put our head in the sand. We know it's going to be true. So a lot of jobs, your job will be enhanced. You'll get more research, more questions, you'll have like a real super assistant, chief of staff on your shoulder when you wake up, but you're still going to be interviewing people. Other jobs, it will handle error rates, or, it already hedges our trading equity floors, and it's already been used for risk, fraud, marketing. Hasn't really eliminated a lot of jobs, but it created effectiveness in terms of productivity by, reducing fraud losses. And then if it changes jobs in operations and elsewhere, we'll deal with it. We have turnover 20% a year. We'd love to retrain people, redeploy them, re-educate them. And so I'm not worried about it. And if it works for the customer and the client, we can kind of do more. That's the other thing. For a successful company, if you're growing and expanding, you're actually almost always getting jobs. So, to me, I want to have a successful company, and we'll deal with whatever the downside is of AI.
And that, of course, was Bloomberg's Lisa Abramowitz speaking exclusively with Jamie Dimon of JPMorgan in London. Lisa, I'm pleased to say, joins us now. And Lisa, all of the AI comments were very interesting, but I actually want to talk about what he said about the public markets, that basically it's odd that we haven't seen more companies going public, given how high valuations are in public markets right now.
Okay, to combine the two ideas, basically you've got a lot of tech startups that haven't necessarily been doing the initial public offerings that so many people kind of need them to do. I mean, Jamie Dimon was talking about venture capitalists, for example, who are expecting to have some sort of exit. When people say the market is closed, though, he was saying, what are you talking about? If you take a look at where valuations are, if you take a look at debt capital markets, if you take a look at where spreads are on corporate bonds, it doesn't look like things are closed. So maybe it's a question of valuation and where that's at. Going back to the AI theme, though, and I think that this is important because when I was speaking with Brian Moynihan with the team a few months back, he said that he expects Bank of America to actually get bigger in size of business, but stay the same with respect to staff because of some of the increased technology. Jamie Dimon said he wasn't sure, that he just doesn't know, and that it's one step at a time and adjusting and adapting as you go.
I thought it was really interesting, Lisa, that he said more mid-sized banks should be merged in the U.S. Obviously, there are thousands of banks. It's a very fragmented market here. But to tie that up with the politics that he was talking about with you as well, he said there's too many regulations here, and people he knows on boards say it's tough to get a merger done because it takes 18 to 24 months. He also named a couple of other national ills in terms of the deficit, for example, or not enough people from the public sector in cabinets. You got some great political commentary out of him, and it does seem like he intimated to you that he's going to endorse a candidate at some point.
He said he'll figure it out. He was a bit coy on that, but he is going to search and figure out what he wants to say or do. There is a bigger feeling, though, and I want to pick up on the point in the Federal Trade Commission and others. There is a question around whether there is a consistent rubric by which companies can understand whether their deal is plausibly going to go through or not. And when it comes to the banking sector, it has proven to be incredibly difficult for all of these banks to get any kind of mergers through. We've talked to a lot of bank executives who've talked about that. His point was really interesting. When people say that JPMorgan is eating the lunch of smaller banks, that it's not really fair because a lot of these smaller banks want to get bigger economies of scale. They want to be big enough to compete with some of their larger brethren. But they can't because they can't get deals through, and that's a real problem, and it really affects the health of the ecosystem. It's a point that's been reflected by other people as well. Question is, given the sort of four-year framework of some of this regulatory outlook, how much can we get that kind of consistency to give people the confidence that they're not going to put up this expensive process without it being turned down only at the end?
All right, Lisa, great reporting, great interview. Really appreciate you taking the time to chat it through with us. That is Bloomberg's Lisa Abramowitz reporting from JPMorgan's Techstars conference in London. And at 11:30, Lisa will sit down in another Bloomberg exclusive with JPMorgan's head of tech investment banking in Europe. This is Bloomberg.
Google joins Microsoft and Amazon in search of nuclear power. And of course, the three together are worth like $10 trillion. These tech giants are searching for energy sources to feed the AI boom and power its data centers. Both Microsoft and Amazon have already secured deals for nuclear power in Pennsylvania. The news has been a boon for uranium producers like Cameco, one of the biggest uranium miners in the world. Part of its business is to sell uranium as fuel for nuclear power reactors. And we're joined right now by Cameco CEO Tim Gitzel. Tim, great having you on the program. It's a hot sector right now. And in fact, I'm a charts guy. I like to look at a 5-year chart on average. Your stock has more than quintupled over the past 5 years, driven in part by a tripling of the spot uranium price. What has driven uranium and hence Cameco's stock until the AI boom? I mean, was it Bitcoin, at least in part, that's driving up the need for alternative power sources?
Yeah, well, good morning, Matt. Nice to be with you. You know, we started feeling tailwinds for our business, the nuclear business, probably 3 or 4 years ago. You know, the whole climate change, climate crisis, climate catastrophe, race to net zero, all of that stuff. People are looking at their energy sources and saying, where are we going to get firm dispatchable power from? So we could feel the tailwinds blowing in our favor. And then we had the Russian invasion into Ukraine, and then people focused on energy security. And again, said, we're going to depend on gas. Wind and solar, great, but they're not firm dispatchable. So people start taking another look at nuclear, and since then we've just been on a tear.
Yeah, it's pretty amazing. On a tear, to put it mildly. You have been CEO of Cameco since July 2011, and I'm curious about how this moment in time compares to the last decade plus. I mean, you think about all the excitement that there is right now around nuclear, around uranium. How does this moment rank?
Well, Kate, I've been doing this gig for about 40 years now, actually, so a year or 14 in the chair here. So if I take you back to the period 2000 to 2011, kind of the renaissance, a word we use lightly now, but a renaissance for nuclear. Things were coming back, nuclear popular. Of course, you had the Fukushima accident, March 11, 2011. That put us really in the penalty box for about 10 years. And so it wasn't really until about 2020 when we started coming out, as I mentioned earlier. And now it's probably the best fundamentals I've ever seen. And there was mention of the hyperscalers, the AI, the data centers. That has just put it off the charts. And we're getting those bigs that you talked about talking with us now and actually making deals for nuclear energy.
So as I said, you're one of the biggest uranium producers in the world. Kazakhstan, obviously a huge source of uranium. And I wonder what the geopolitical picture looks like for you in terms of getting to the minerals.
Well, you know, we're blessed. We're up here in Canada with some fantastic ore bodies, uranium ore bodies, the 2 largest high-grade ore bodies in the world that we operate up in Canada. We also have a joint venture with the Kazakhs in Kazakhstan. Kazakhstan produces about 40 to 45% of the world's uranium, so it's a big player, and we need them. They're squeezed. They're in a tough neighborhood. They're squeezed in between China and Russia and have those pressures. So, yeah, we need everybody producing these days. If we're going to hit the goal of tripling nuclear power, as everyone's talking about, by 2050, we're going to need a lot more uranium.
Well, with that in mind, I mean, talk to us about your capital priorities here. Of course, you've enjoyed a massive run-up in your stock over the last 5 years or so. Again, like Matt says, this is a very hot sector right now. Have to imagine there's more money coming your way. With that in mind, what are your priorities? Are you looking to maybe merge with another company, acquire another company? I'm sorry, Matt. I mean, what are you looking at right now?
Yeah, so Katie, we're all in nuclear. We have been from the start. We've been traditionally focused on uranium. As I say, we've got some fantastic uranium ore bodies. We're looking to extend and expand those where we can. We're involved in conversion, which is the next step in the nuclear fuel process. We make nuclear fuel as well. And then about a year ago, November last year, we closed a deal with Brookfield, a big Canadian financier. We partnered on purchasing Westinghouse, the American icon, really, in nuclear power. And so now we have the full suite, right from uranium to nuclear fuel, and we can build reactors, the small SMRs and the large AP1000. So we put all our chips in the middle. We're all in on nuclear.
We often hear about reactors, new projects. For example, the Bill Gates documentary outlines one that'll use the waste spent fuel in order to, recycle that material. What are your hopes for even cleaner nuclear reactors, and how long is it going to take to get them online?
Yeah, so we're moving now. I mean, the demand is there today, and so you've got the traditional, I'd call them Generation 3 or 3+ reactors that, there's 440 reactors operating in the world today, another 60 under construction. Most of these are what we call Generation 3 or 3+. Like the airlines industry, we learn from past practices. They're even better today, and we're working on these Gen 4, like Bill Gates's project in Kemmerer, Wyoming, and so we've got a real suite of options out there. We're working on all of them. Up here in Canada at Ontario Power Generation, they're building one of the first SMRs. They hope to have it in production by the end of the decade, and so we're moving ahead.
And before we let you go, I am curious just about the price of uranium. I mean, it's a metal that maybe not a lot of people look at on a regular basis, but we had that long-term chart of uranium up. And if you take a look over a 5-year basis, you see a big run-up in uranium prices. But if you zoom out, you max it out to 20 years, of course, we are well off the levels of the last 20 years. So just talk to us about that evolution there. Of course, what was happening over the past 2 decades and why we're at these levels relative to history?
Yeah, so as I was talking about that period, 2000 to 2011, the renaissance for nuclear, if you like. So we saw many countries around the world looking to build new nuclear, so looking for uranium as well. The price ran up from about $10 a pound US to it was over $136 a pound in 2007, and then settled back the day before Fukushima accident. It was about $73 US a pound. Then we wrote it down to about $17 a pound again in 2017, and now recently we've seen it over $100 US again. I think it's about $83 today, and we think there's a lot more room to run yet with the growth in nuclear energy.
I just want to finally ask Tim how much support you get from governments. It's obviously imperative for governments to get enough energy to be able to charge up EVs if they want to go in that direction. The nuclear power generation for AI is now a key, but there's so many other reasons that we need to get these things online. Do you get help from the Canadian government? Do you get help from the U.S. government? Are you even getting help from European governments?
Yeah, well, we have been. In fact, if I look down in the U.S., the Inflation Reduction Act had this billions of dollars for new nuclear production tax credits, things like that. The ADVANCE Act to try to streamline the regulatory processes, prohibiting Russian import of nuclear fuel act. So there is support in that regard from the U.S. government. Canada, the same thing, very supportive of new nuclear. They know we need it. If we're ever going to get to net zero and have enough electricity, we need nuclear as part of the solution. So we're seeing support around the world, countries around the world. And so as I say, it's probably the best fundamentals for nuclear I've ever seen in my 40-year career.
All right, Tim, that is a good place to leave it then. Really enjoyed this conversation. Hope to have you back again soon. That, of course, is Tim Gitzel of Cameco. Meanwhile, a little bit over an hour into the U.S. trading day, let's take a look at how markets are faring with Bloomberg's Abigail Doolittle.
We're seeing a nice rally right now, Katie. After yesterday's roughly 1% drop, the worst day in a month for the S&P 500, we now have stocks up about 0.6%, and you can see really climbing as the morning is going on. Now, beneath the surface, starting off with some of the laggards, if we take a look at the shares of Roblox, we are going to see that they are down, at this point, down 3%, well off the pre-market lows. But this, of course, has to do with that Hindenburg short report saying that this gaming company, they're short this gaming company that has not been profitable since it has been a publicly traded company. Now, we're talking about weakness for some of the China tech-related stocks on disappointment that the Chinese government has not offered new stimulus. That's true, too, for some of the casino stocks, including Wynn Resorts, after a big rally into today, down about 3%. Turning to some of the winners on the day, DocuSign up more than 8%, being added to the S&P 400 mid-cap index. That means all of those index managers will have to add DocuSign to their portfolios. NVIDIA up for a fifth day in a row, up 3.3%. And very interesting on this, Matt, we of course have this race among the stocks that are above $3 trillion market cap. NVIDIA is now the world's second largest company. What we're looking at here in orange, Microsoft, white, Apple, and then green is NVIDIA. You can see Apple is leading the way, but on this recent gain for NVIDIA, it is now above Microsoft's market cap. It's also worth noting, I was surprised by this, when I looked at Microsoft's gain on the year, it's a single-digit number, 9.9%, but nonetheless a single-digit number. So Microsoft really not keeping up with some of the other tech games we're seeing.
Yeah, absolutely fascinating stuff and huge, astounding market caps. Abigail, thanks very much. Bloomberg's Abigail Doolittle walking us through some of the big movers. Coming up, a story about the effect of the urban doom loop on metropolitan life. Harvard University professor Ed Glaeser discusses San Francisco post-pandemic. This is Bloomberg.
All right, it's time now for our daily Wall Street Week conversation. And like many metropolitan cities around the country, San Francisco was hit hard by the pandemic. But can it recover? David Weston speaks with Harvard University professor Ed Glaeser about the city's future.
So in our list of 50 metropolitan areas, where we just form a sort of naive statistical index of those four measures, San Francisco was last out of 50 metro areas.
That means in the worst shape?
It is, in fact, in the worst shape in those out of those 50 metropolitan areas, yes. Now, in part, that's a little bit misleading because, remember, the fact that its prices have not gone up by as much as other cities, or gone up or have declined a little bit in real terms, that partially reflects the fact that it was, an unbelievably successful place in 2019. So San Francisco can lose the little mojo and still be a pretty remarkable place. And the human capital, the education base of San Francisco, which is part of its magic, right? I mean, 60% of Detroit's adults have college degrees, which is a very high number. That created a short-run problem because education is so closely linked to working from home. In May 2020, 58.9% of Americans with advanced degrees were working remotely, as opposed to only 15% of Americans with just a high school degree. Right? Huge links even today in terms of education and working from home. That education then meant that the office is emptied out more quickly and more permanently in San Francisco than elsewhere. But I would still bet on the educated parts of America as being the most able to reinvent themselves over time. Right? I have a mantra, which is the right economic development strategy is to attract and train smart people and then more or less get out of their way.
Do you have a sense of whether at this point San Francisco is attracting or actually driving away some of the smart, talented people?
I think this is again, you're starting from such a high base that, it's hard to imagine that it could possibly be at the same place it was in 2019. The city certainly itself has lost a bit of luster, a great deal of anxiety about quality of life problems going on in San Francisco. Which means that people actually don't want to drive into the city for fear of getting their car stolen, or unpleasantness with, fentanyl-related incidents. All of these things are real things, although the crime rate has not risen particularly much in San Francisco over the past five years. It's relatively flat on most measures. But these are real problems, and the city, in some sense, needs to remember that attracting and training smart people isn't an easy job. And in fact, in some sense, the most important way to compete for talent in the 21st century is quality of life. And when quality of life falters, the city will inevitably falter.
Is there any way to get a sense of cause and effect? Insofar as it has come down a bit, San Francisco, do we have a sense of prime drivers of that?
I think it's overdetermined at this point in time. We look at lots of things that are going on in San Francisco, the very high business vacancy numbers, the fact that out of 10 metropolitan areas, they're tracked by the Castle technologies. These are key swipes or other technologies for enabling you to go into work, and they're measuring the level of occupancy relative to pre-pandemic.
And that was Harvard professor Ed Glaeser speaking to David Weston. And of course, you can catch Wall Street Week every Friday at 6 p.m. Eastern. Meanwhile, let's take a check on these markets because, boy, do we have a rally on our hands. You take a look at the NASDAQ 100. We are at session highs, up 1.4%, helped in a big way by a big rally that we're seeing in Alphabet, in T-Mobile, in AMD. It's pretty amazing. You also have NVIDIA doing well as well. Actually, over the past 2 days, we're now basically unchanged to a little bit higher on the NASDAQ 100. So it's like yesterday's big decline, it didn't even happen. Now coming up, Hurricane Milton set to approach the Florida Peninsula as a Category 4 storm, bearing down on a region still struggling to recover from Helene's devastation. We'll discuss how the U.S. government is preparing. This is Bloomberg. Well, we have just 28 days until the presidential election, but residents in Florida have more immediate concerns as evacuees flee Tampa and storm watchers track the intensity and the path of Hurricane Milton. Vice President Kamala Harris has criticized her opponent Donald Trump and Florida Governor Ron DeSantis for, quote, political gamemanship. Joining us for more on the campaign and the hurricane response, we welcome in Bloomberg senior Washington correspondent Saleha Mohsen. And let's start there, Saleha. Talk us through the different responses that we're seeing from both camps here.
Yeah, we're seeing Biden doing what a president should do. He is in touch with Ron DeSantis, has let him know that he can call him at any time. He is engaging with FEMA, engaging with Congress to get more money and resources to these locations. And we are seeing Trump and Harris do what is expected of two presidential candidates in a very close and heated contest. They are each accusing each other of all sorts of things. Harris most recently is talking about gamesmanship and politicizing the hurricane, but maybe making those comments is also a sign of her politicizing the moment.
How has Harris been doing in her sort of friendly media blitz? She was on 60 Minutes yesterday. I believe she's going to be on Howard Stern as well as The View. Obviously, the latter is incredibly, the latter two are very friendly, as Howard Stern famously hates Donald Trump. Did she get any hard questions on 60 Minutes?
You know, there were a couple of moments where it was digging at some of the key questions, particularly when it comes to NATO and Ukraine and their membership. And she kind of sidestepped that one, saying she would cross that bridge when and if you get there. So she didn't want to answer or offer any hard, promises. But yeah, I mean, she is kind of trying to thread the needle here by being out there more, talking to more media so that no one can say, well, you haven't spoken to anyone, as she hadn't most of August and part of September. But also she's not giving interviews, taking on these moments with some of the harder hitting news outlets. I mean, Bloomberg News would love to ask her some economic policy questions. Our questions would be hard and get to the root of some of the missing elements of her economic policy pitches. And so we're not seeing her talk to the New York Times, talk to major outlets, Bloomberg News. She's going to podcasts where she can have conversations that kind of continue this contest of like a personality war between her and former President Trump.
And she does, I mean, all politicians do, and she is very also adept at sidestepping questions. Stephanie Ruhle asked her a couple weeks ago about the SALT deduction cap. She didn't answer that question. Do we know, Saleha, how the Democrats feel about lifting the cap on state and local tax deductions?
I don't know that they've gotten that deep into it right now. Every single Democrat, every single lawmaker who is on the ballot this year is fighting to win the race so that they actually can have a perspective that could factor into where tax policy is headed.
And it's interesting. I mean, I do want to talk a little bit more about the medium here. As you make the point, of course, we're not talking about traditional interviews with Bloomberg, for example, but it's interesting to see both candidates here embrace podcasts. We were talking about Kamala Harris, of course, on Call Her Daddy, sitting with Howard Stern as well. But Trump, too, has appeared on podcasts, of course, with Dave Ramsey, also with Theo Vaughn. I think he was on the All In podcast as well. So it's just interesting to see that emerging as a medium that these candidates are embracing.
Absolutely. As much as, policy folks and the serious reporters and serious outlets would love to get a chance at asking both Trump and Harris some serious questions, it is possible that this is not the moment for those hard, deep policy questions, because it depends on who wins the White House and what the power structure in Congress and each chamber of Congress is before a president can try to enact their vision. So there's too many hypotheticals there. So by going on podcasts and The View and Howard Stern, each candidate is able to reach an audience that maybe they wouldn't be able to through some of the more traditional forms of media. And the fact that they are choosing these podcasts really shows how influential the podcast industry has become, how some of those influencers and podcast hosts who come with their personalities on these shows, how influential they've been and what that medium means. There was a Pew Research poll from a couple of years ago that, only about 18 months ago, that showed that of the media, podcasts have the highest level of trust in an era where we are seeing the public's trust in the media and the government at all-time lows.
All right, Saleha, thanks so much for joining us. Appreciate your time. Bloomberg's senior Washington correspondent, Saleha Mohsen, talking to us. And you can dive into, by the way, Bloomberg's comprehensive analysis of all facets of the campaign with your Bloomberg terminal. Type ELEC GO on the terminal. I also like WSL to give you some chart libraries there. On the subject of podcasts,
we both have podcasts.
A podcast. Everyone knows about yours.
That's not necessarily true. I have the Money Stuff podcast with the other Matt Levine. You have Hot Pursuit with Hannah Elliott.
Yes. So, and mine, of course, is less hard-hitting. And
you do some big interviews.
We do interview automotive CEOs.
You
For example,
do.
we had Jim Farley, we had Mark Royce, the president of General Motors, but mostly we just talk about cars.
Yeah, well, Matt and I just interview each other. Matt Levine, my other Matt. In any case, let's take a quick check on the markets because we have a rally on our hands. The NASDAQ 100 at session highs or pretty close to it. The S&P 500 also up pretty mightily, up about 0.8%. We're going to continue to follow this rebound throughout the day, but coming up tomorrow on Open Interest, we'll be joined by Ferguson CEO Kevin Murphy joining us in the C-suite. This is Bloomberg.